Understanding risk analysis, a comprehensive overview. What is risk analysis? Risk analysis is a systematic process for assessing potential adverse events that could negatively affect an organization and its environment. It is a crucial practice in various sectors, including businesses, government, and non-profit organizations. Corporations such as banks, construction companies, and healthcare providers often employ risk analysis to determine the viability of projects, financial applications, and strategies for protecting their interests. The core aim is to balance risks against risk reduction, providing a framework for informed decision-making. The importance of risk analysis. Understanding risk analysis is pivotal for organizations to evaluate the probability of adverse events affecting business operations, investments, or projects. By comprehensively assessing risks, organizations can determine the feasibility of specific initiatives and implement measures to mitigate financial impacts. This process is multifaceted. It involves identifying potential risks, quantifying uncertainties, and ultimately devising strategies to manage those risks. Key components of risk analysis. Risk analysis can be broken down into several essential components. Identifying risks, recognizing potential hazards that could disrupt operations or threaten success. Measuring risks, utilizing qualitative and quantitative approaches to assess the likelihood of risks occurring and their potential impact. Mitigating risks, developing strategies to minimize or eliminate the identified risks. Risk communication, ensuring that stakeholders are adequately informed and prepared to address potential risks. Types of risk analysis. 1. Risk-benefit analysis. A risk-benefit analysis compares potential benefits with the risks associated with them. This analysis helps organizations determine whether the expected outcomes justify the risks involved. 2. Needs assessment. A needs risk analysis evaluates the current state of an organization to identify gaps or deficiencies. This analysis may help management direct resources toward areas requiring improvement. 3. Business impact analysis. This analysis focuses on understanding how specific risks could affect the business. For instance, if a labor strike is expected, a business impact analysis will assess how delays might impact overall operations. 4. Root cause analysis. Root cause analysis is conducted and a problem arises that needs rectification. This process seeks to identify the underlying causes of issues, allowing organizations to implement effective solutions. Performing risk analysis. Conducting an effective risk analysis typically follows these 6 steps. Step 1. Identify risks. Collaborate with team members across departments to pinpoint potential risks. This brainstorming session can enhance the breadth of identified risks. Step 2. Identify uncertainty. Recognize areas of uncertainty related to each identified risk. For example, a company facing a product recall may not know the exact number of defective items it has shipped. Step 3. Estimate impact. Assess the financial implications of each risk by calculating the risk value, which is the product of the probability of an event occurring and the resultant cost. Step 4. Build analysis models. Utilize statistical models to process the data collected, yielding various scenarios and outcomes that can provide insight into the risks. Step 5. Analyze results. Evaluate the outcomes generated from the analysis models to make informed decisions regarding risk management. Step 6. Implement solutions. This may involve accepting, reducing, or eliminating risks based on organizational strategy. Solutions can include purchasing insurance, streamlining operations, or partnering with other entities. Qualitative versus quantitative risk analysis. Quantitative risk analysis. This approach relies on mathematical models and simulations to assign numeric values to risks, allowing for statistical analysis of potential outcomes. Techniques like Monte Carlo simulations generate a range of possible outcomes based on random variables. Qualitative risk analysis. In contrast, qualitative analysis utilizes subjective assessments and descriptive methodologies to evaluate risks without numerical ratings. This approach is often used in conjunction with other risk analysis tools like SWOT analysis and cause and effect diagrams. Example of risk analysis: value at risk, VAR. Value at risk, VAR, is a popular metric that quantifies the financial risk in an investment portfolio. By analyzing historical data, risk managers can estimate the potential losses within a specified confidence interval, e.g., 95% or 99%. While useful, VAR has limitations and does not predict extreme events or black swan scenarios effectively. Advantages and disadvantages of risk analysis. Advantages: informed decision-making. Risk analysis equips companies with data-driven insights to make proactive decisions. Financial implications: organizations can quantify risks and allocate resources to mitigate potential negative impacts. Early warning signs: identifying potential risks helps companies strengthen internal controls and processes. Disadvantages: probabilistic nature. Risks are inherently uncertain, and analysis is based on estimates that may not capture true risk exposure. Lack of standardization. Different methods of risk assessment can lead to inconsistencies in results. Underestimation of extreme events. Traditional risk models may fail to account for significant downturns or catastrophic events. Conclusion: risk analysis is an essential tool for organizations seeking to navigate the complexities of potential adverse events. By understanding risks and implementing appropriate mitigation strategies, companies can protect their assets and ensure longevity in an often unpredictable environment. Whether through qualitative or quantitative methods, effective risk analysis enables businesses to make informed choices that balance potential rewards with acceptable risks. As industries evolve, the methodologies and importance of risk analysis will continue to shape successful organizational strategies.